then people took it offline and pursued it if they were interested. Then we invited somebody from the Global Impact Investors Network to give us her views on their initiative during COVID and beyond. Then we had two seminars on valuation, part 1 and part 2, with different speakers. And then we decided to go and ask Juan Pablo Cappello if we all can mute our phones. Thank you. We decided to invite Juan Pablo and as well as Victoria, because they are huge supporters of the venture capital industry. They don't need an introduction. We have put their backgrounds in the invite. I just have to say that I have a huge admiration for Juan Pablo, what he has built in so many years and so many scars cured and put to work. So it's always a pleasure to count with your support. So having said this, thank you, Juan Pablo, thank you, Victoria. I know you're very busy, but always giving back to the community and to the ecosystem. And let's start with the part 1 of this training. And even though, feel free to begin to ask questions, the part 1 focus on the 2 mistakes Latin founders keep making. So, Juan Pablo, Victoria, the floor is yours.
Great. I'm gonna start. Yeah, no, it's been a real pleasure collaborating with Marta, with Susana, and many of you over with some of you, the last 20 years. I actually started working with Victoria. We were at Patagon. That was, unbeknownst to us, the first fintech in Latin America. Fintech didn't even have a name back then. So we were just a .com and trying not to be a .bomb at those times. But Victoria was actually the sort of first hire I made it at Patagon, and here we are 20 years later, still talking about venture in Latin America. So I'm going to sort of focus on 2 mistakes that we just see founders make over and over. I think it's relevant to you all as investors, because these 2 mistakes, I think, really can help inform the kinds of companies you want to invest in or not. So let me try to share my screen. Here we go. So the first point I want to make, and it ties into, hold on, let me, if I can, maybe that's better. Yeah. That is that, in Latin America, especially for the ones of you who aren't from Latin America, there's really this issue, unfortunately, where we don't actually appreciate who we really are. And the reason I love this map, and it's from a very well-known Uruguayan artist who created this Escuela del Sur, School of the South movement in Latin American art, where it sort of said, the South needs to be our North. The same way, unfortunately, in English, often, the word like, it was the darkest of days. It's somehow being dark is negative and being white is positive. There is this, unfortunately, in Latin America, this sort of sense that the North, and literally the Northern Hemisphere is better somehow than the Southern Hemisphere. And what I really love, and I literally have this sort of in every office, everywhere I work, etc., is, hey, why don't we put and think about Latin America as being the center of the world, not at the margins, right? And so because of that, unfortunately, a lot of Latin American entrepreneurs, rather than building solutions for the great mass of our Latin American consumers, end up building solutions for a very tiny percentage of the potential consumers in Latin America. And not surprisingly, those business models are very, very rarely successful. And so I describe it as, they're building a bridge to nowhere, because it's actually, from my perspective, quite simple, which is that if in Latin America, where's the big opportunity? The big opportunity is we have a continent which is over 600 million people, which is adapting, that's connecting to the internet for the first time. I mean, literally 50 plus million people a year are getting onto the internet for the first time. They're getting on with not very fancy phones. And the big opportunity in Latin America is to build solutions for those people. I mean, we can debate, how far down the pyramid we should go. Is it, the bottom third, the middle third? But the reality is, so many projects that I see are building solutions essentially for the people in Latin America who have iPhones, or the people in Latin America who have credit cards. And if you're not from Latin America and you're used to dealing more with developed markets, you might feel like, well, 70% of people that I know have iPhones and everyone I know has a credit card. So you're not really limiting yourself that much. Well, in Latin America, in terms of people with cell phones, with iPhones, you're probably talking about the top 3% of the whole continent. So suddenly you've taken your market from 600 million to, 12 million, 18 million, 20 million. And similarly, when you're targeting people who have credit cards, well, that's a very small subset of the overall potential market. So, the first thing I would say is, when you look at projects, you just have to really understand that the big opportunity in Latin America, and if you look at most of the unicorns, it bears this out, they're not trying to build, a copycat of the business model that worked in the US, and they're trying to tropicalizarlo, to tropicalize it. In fact, the best companies coming out of Latin America are helping solve a problem for somewhere down the pyramid where you have a big group of people, right? And so, if you look at Nubank from Brazil, or you look at Rappi with the food delivery, but Rappi with the food delivery, what's interesting is we always had, so you might say, oh, well, only rich people get food delivered. True, perhaps. But with all the sort of informal motocicletas, which are almost the equivalent of Uber drivers, which have always existed on motorcycles and bicycles and sort of informal, the shoe leather express kind of people, that, those people are being put to work. And so Rappi's clearly tapping in to something, uniquely, if not Latin American, uniquely less developed economies. And so the first mistake I see entrepreneurs make over and over, and I mean, to give you an idea, probably 80% of the business plans that come through my office involve business plans that, when you actually peel away and you think, who are the consumers here, it's only the very wealthy in the region. And that's not an interesting market. So that's my first sort of observation. My second observation, I'm going to share my screen again, is let's see, here we go, is this issue of exits in Latin America. And again, I think a lot of entrepreneurs in Latin America, which is fine, and I know it's one of the things that you all are trying to address, is a lot of entrepreneurs in Latin America have traditionally been, they might be Latin, but they have European, sort of blood. They're males, and they're well educated, and many of whom, if they had a choice, they would have, liked to have been born in the United States. I mean, that's the reality. And so because of that, they end up, being often inspired by the business practices and the business models in the United States. And so that's why, we have so many, such a large percentage of projects from my perspective, building a bridge to nowhere. But then secondly, there so many entrepreneurs are, especially now in the time of sort of easy money in venture in Latin America. And the reason I say easy money is if you look at the evolution of the money invested in tech over the last 3 years, it's doubled. So when Marta Cruz launches NXTP, the TecnoLatino was about $150 to $300 million year over year. When Susana starts at the IDB to support entrepreneurship in the region, the TecnoLatino was 150 to 300 million for 10 years. From 2000 to 2010, it was just, go up to 300, down to 170, up to 220, down, and there was no real growth. That began to change in part when NXTP and WIDA and a few others, brave pioneers, began deciding that things needed to change. Susana began doing some incredible work to support entrepreneurship, angel groups, female investors and entrepreneurs, and that's been great. But in 2017, we were at about $1 billion. So we'd gone from say 2 to 300 million to $1 billion. But then in 2018, we doubled to 2 billion. In 2019, we doubled to 4+ billion. And so now you have a lot of entrepreneurs who are really focused on doing these big rounds, building these unicorns, et cetera, which I think is on one level great. But what we have to keep in mind, and what I really try to point out to entrepreneurs, is where your exit's going to come from. And what you have to keep in mind is in the United States, over 90% of exits in tech-enabled businesses are between $25,000 and $250,000. And I'm leaving aside the acqui-hires, which tend to be $2 to $10 million transactions. So in the United States, the vast majority of exits are either acqui-hires, which are $2 to $10 million exits, or real acquisitions where they're really buying the IP or the business model beyond just a team, and those are exits of 25 to 250 million. So here's the point. Every time a company raises money, if it's going to follow the typical trajectory of a successful tech-enabled business, it's going to double or more likely triple its valuation every time it raises money, right? So if a company raises at a $3 million valuation, almost invariably 12 to 18 months later, it needs more money. Doesn't matter if it raises $1 million or 100 million, it blows through the money in about 18 months. So if the company raised at 3, the next time it's raising money, it needs to raise probably at a 9. Well, now at a 9, it needs to say go to 30, and then close to 100, and then 300. Well, what's the problem? When you see companies in Latin America raising money at $100 million valuation or higher, for me, that's a big problem. Because the question is, who's the buyer at 300, at 600, at $1 billion? And we have a legal practice where we've worked with over 600 entrepreneurs from Latin America and their companies. So we have a huge amount of deal flow. We're Mercado Libre's lawyers, Open English lawyers, Gympass lawyers, 99 Taxis lawyers, and dozens and hundreds of very early stage companies. I personally, in the last 3 months, have had Zoom calls with 10 different founders of Latin American companies that have raised a lot of money. And when I talk to them about who's going to buy their business, every one of them has mentioned Magma, Microsoft, Amazon, Google, Apple, and a few other strategics. Magma, on average, buys one company for $1 billion a year. So think about it. Google, on average, buys one company a year for $1 billion plus. Apple, on average, buys one company a year for $1 billion plus. So the reality is, when you're investing with entrepreneurs in Latin America, a lot of them get, especially now where money's been easy, especially not early stage, but the later stage money has been easy. They're very focused on raising the money, but they're not focused on what happens the next day. Because, and I'm going to give you a very concrete example. I was working a few years ago with a Latin entrepreneur who is quite successful. He brought me a term sheet where he was going to raise about $100 million at a $400 million valuation. And I told him, don't do it. Es el consejo de la abuelita. It's a advice of the grandmother. Just because you can do something doesn't mean you should do it. And quite honestly, he got quite offended with me, and he said, no me tienes fe, and you don't believe in me, and I can't believe it. I said, no, I believe in you, but here's a question. How many buyers of your company are there at a $200 million valuation? And he's like, 20. I mean, just, I could selling it so cheap, and I could sell it to anyone. Okay. How many buyers of your company are there at an $800 million valuation? Stops and thinks about it, and he says, maybe 2, and an IPO. I, as an investor, would much rather that entrepreneur, I mean, it depends. If I really believe he's, this is the next Mercado Libre, this is just going to be a trajectory up, et cetera, maybe I'm going to be different. But the reality is there's very few Marco Galperins in the region. There's very few Messis in the region. There's very few Federers in this world. And yes, if the entrepreneur you really believe is at the level of an Elon Musk, if you really believe is at the level of a Mark Zuckerberg, go for it. The reality is, I've met hundreds, if not thousands, of entrepreneurs in the region. I can honestly say, I can only think of 2 or 3 that I've met in all of my years who I really believe have that kind of potential. I think everyone else should be focused on selling their companies for between $25 to $250 million. And the reality is, in Latin America, many of us are going to invest in companies which, get some traction, but then don't really take off, right? They get sort of stuck at $50, $80, $100,000 a month recurring revenues, which, by the way, in local currency is a lot of money. It's nothing to be ashamed of. And those companies, unfortunately, now are sometimes in a position where they can raise $5 million at a $20 million valuation. But again, from my perspective, there's no exit, because once they raise money at that high valuation, who's going to buy them? The reality is no one. So for those companies, I think what we need to start doing is taking less money, making those companies attractive to be bought by local economic groups for $2, $3, $5, $8 million, rather than trying to raise the maximum amount of money possible. And by helping those companies engineer an exit, we're going to have not only trying to have an ecosystem based on home runs, but an ecosystem based on, singles. And I'm not a baseball player, but I hear Americans use this terminology, singles and doubles. And, rather than every time that, there's an entrepreneur, the entrepreneur is getting pushed to try to, create the next unicorn. And quite honestly, I love Endeavor. And if there's any representative from Endeavor, that's great. And, I make a living offending people, so that's fine. But, I think sometimes Endeavor has, this idea of, you go big or you go home. And again, I think for a certain kind of entrepreneur, he or she needs to be nudged and pushed to really try to think big. And I know that sometimes with female entrepreneurs, that's a bigger issue. But the reality is, especially in this market with the abundance of capital, again, we've gone from 150 to 300 million, and it took us 7 years to get up to $1 billion. And then we went from $1 billion to $2 billion to $4 billion within 2.5 years. And that, I think, is distorting the long-term focus of many entrepreneurs. And I think the long-term focus of entrepreneurs needs to be either you build a sustainable business that's going to, you know, generate a lot of cash, and that's wonderful. But then if you're going to do that, you don't go out and, you know, try to do a C round at a $100 million valuation. Or, you know, for most entrepreneurs, you try to create a company that's going to be attractive to an international buyer at that 25 to 250 valuation. And that's amazing. And that, you know, for an investor is a great return if they don't, you know, go crazy on the valuation early. Or you generate a company that's more of an acqui-hire kind of target if you see that it's not really scaling. But then, you know, you don't have, as they say in Spanish, the delirio de grandeza. You have to help the entrepreneur, you know, realize that, hey, this is probably not going to be the next unicorn, and that's fine. And you support him or her, and you help, you know, you help get the company into a place where it can get sold. So anyway, those are two big picture things. One, building a bridge to nowhere, which for me is targeting too affluent demographic in Latin America rather than focusing on the big opportunity, the middle or further down the pyramid. And then two, this issue on exits. So with that, we have half an hour. Victoria is going to take it from here and talk about Delaware versus Cayman as an alternative for setting up a holding company, and why those are really the only two realistic alternatives for 99% of entrepreneurs. I'm just going to give a brief overview of the subject, which is, in our experience, for Spanish-speaking entrepreneurs, and we actually invented the, when I say invented, we sort of convinced CASEC and NXTP and a few others to accept Cayman as a jurisdiction. And so today, in terms of Spanish-speaking founders, about 75% start with the Delaware holding company, occasionally an LLC, but eventually a C Corp. And about 20, you know, I'd say 24.9% go with Cayman, and, you know, less than 0.1% go with some other jurisdiction. In Brazil, it's almost 50-50. The Brazilians have embraced Cayman even more than the rest of Latin Americans. Cayman was on the EU blacklist for most of 2019. I published an article about it about a month ago, and literally the next day, the EU took Cayman off the blacklist. So I've just taken all the credit on social media. I've said it's only because of my article that happened, which obviously is a joke. But anyway, so Cayman's off the blacklist, and Vic's going to talk about when one might be more appropriate than the other. So with that, Vic, you want to take it away?
Yeah. Hello, everyone. Thank you so much, Marta, Susana, Megan, Silvia, and of course, Juan Pablo, who has been my mentor since I moved to this country 20 plus years ago. So as lawyers, I'll start with a brief disclaimer. This is not, we are not giving any type of legal advice or tax advice. So with that out of the way, I'll proceed. I would love to start by the conclusion. What I have learned in my experience on the venture world is that you don't need to get creative here or look for an eccentric, try to, you know, bring to the table a brand new jurisdiction, and the same with the legal documents. The more you follow the market practice, the better for you. This week with Juan Pablo, we got we were talking with an entrepreneur who wanted to set his holding in the Zona Libre in Uruguay. And yeah, I mean, you can do it, but how many companies you know that funds have invested in such a company? So keep those things in mind all throughout your growth process. So with regards to the choice between Delaware and Cayman, I wanted to bring a couple of big picture items to the table so that you can keep those in mind. Usually the C Corps work best for US founders when you have the IP that has been developed in the US, when the principal target market is the US, when the mind and management of the company is in the US. And why is all this relevant? Because being a C Corp has a lot of benefits and also some responsibilities, especially from the tax point of view. So the C Corp, it's what it's called a blocker. So it has to pay a corporate tax of 21% on a worldwide basis earnings. So even if the company doesn't sell in the US, or the founders have never been to the US or don't even have a visa, you will still need to pay this tax. And also at the second level, it needs to pay taxes when the company distributed dividends to its shareholders. So in this case, usually it's around 30%. So all in all, it can come up to 50%. So it's a big element to keep in mind. And as Juan Pablo always like to say, being in Delaware, being in the US, being in a C Corp is like the Hotel California song. Once you're here, you cannot check out. Because the only way to leave it is by either selling the company, liquidating the company, and of course, throughout those transactions, you will still need to pay whatever taxes are due for such transaction. On the very easy and positive side, I know that sometimes incorporating a company in our jurisdictions, I'm originally from Argentina, as you can tell by my accent, it's a very complicated process, it takes forever, a lot of bureaucracy. But here it's very, very simple. Between 2 to 5 days, we can have the company up and running, ready to operate. It's very simple, depending on the jurisdiction. Certain documents are public and the rest is private. And you're good to go with the entity. On the other hand, in Cayman, it's as Juan Pablo was just saying, it's off the blacklist in Europe. The funds are, familiar with it because a lot of them had either feeders or structure there. So it's not BVI, it's not Panama, it's not Zona Libre in Uruguay. It's a little bit more expensive. It might take a little bit longer, maybe 2-3 weeks. But on the tax front, usually this jurisdiction is preferred because they don't charge corporate tax on income generated outside of the Cayman Island. And there is also no tax on distribution paid by the holding company to its owners. In Cayman, if the owner is in other jurisdiction, at their personal level, they will have to check on their respective jurisdiction what is their tax liability there. It can be a little bit more expensive, it can take a little bit more time. And what we have seen is that usually you have Cayman as a holding company, below it you have a Delaware LLC, and then you have all the subs that are the operating companies in Latin America. Another positive aspect of Cayman is that you can change the structure in terms that if later on, because of the investor are asking for it, you can have it domiciled in Delaware, for instance. But you cannot do that the other way around. You go from Delaware to Cayman. The one thing I will point is the cost, that usually in the US the costs are lower, and in Cayman the cost of the ticket it's a little bit higher. So another phrase that I like a lot from Juan Pablo in these cases is that el que tiene la plata elige. Whoever is bringing the money will tell you what to do. So we have seen many times that in the term sheets before an investment takes place, you put as a condition precedent that, I don't know, if the company was incorporated in Florida, you're going to have it domicile or convert into a Delaware company, and the same coming up with whatever the structure is that the investor may want. Usually, if you're talking about US funds, what they want is a C Corp, a structure that they know, that they're familiar with it, they know how it works. And as Juan Pablo was mentioning in a different context before, in the venture capital world, the investors see hundreds and hundreds, if not thousands of opportunities. So the minute you have something exotic, something that is not market practice, I think my sense is that you're getting back in the line. So the more standard you go, probably will be the best for the project. And the same.
Sorry, Victoria, one question. Somebody's asking, when you say Delaware, is it only the C Corp, or LLC as well regarding taxes?
No. The LLC has a different structure in the sense that the LLC is not a blocker, so you only pay at the distribution level. But usually, if you're targeting to U.S. investors, they are not too keen on investing in a Delaware LLC because they will have to disclose who their partners are. And usually, what we have seen a lot is that LLC in Delaware works when you have foreign investors too. And that's why we were mentioning a very standard structure that we see is Cayman, Delaware LLC, and then the subs. And remember, something else is that once you figure out where you want to have your holding, something important is how you transfer the underlying subs to the holding. And usually it's a very simple, straightforward process that you will have to coordinate with your US counsel and local counsel. You do a permuta and exchange agreement, and you make sure that all the subs are in place under the holdings. That's a must in any due diligence. And if I may jump, I don't know, Juan or Susana, regarding this topic of consistency, uniformity, following the market practice, we wanted to touch on the most standard documents that we see. So if you're planning on raising capital as equity from $0 to $1 million, the most accepted market terms have been developed, and you can find them at serieses.com. It's very standard, very friendly, and unless you have something in particular to do, all you need to do is go there and fill in the blanks with the sense that it won't take forever to negotiate them because the terms are very, very market. And this document came about after years and years of discussion and frustration because without this, in every small deal, you were reinventing the wheel in terms of legal terms. And it didn't make sense to have, you know how expensive lawyers can be, especially in the US. So maybe you were raising, I don't know, $500,000 and 50K were going out in legal fees. And you reach a moment that didn't make any sense. So I'll strongly recommend and suggest to all the founders to take a look at the serieses.com set of documents. The other alternative...
Sorry, somebody's asking if you would also recommend NBCA's standard document.
That's the second one I was going to mention. Those are usually, they're a little bit more complex. And those are for larger, when you're raising more than $1 million too. After this Zoom, we can share with you all the links. But there's what I love, because I have two hats. I work with Juan Pablo, but also I'm an entrepreneur myself, that there's a lot of open source materials out there, because the entry cost for an entrepreneur in every different aspect is really high, from paying legal fees to registering IP to you name it. And the fact that in the community, in a nice way to pay back, but also to facilitate their day-to-day investment activities, that they have put out all these documents, it's amazing. So we can share both links after we talk. And also, I wanted to chat super briefly to make the reference. If you're going to invest in equity, you need to keep in mind and agree on valuation terms. Sometimes that's really hard at the beginning of a project. So another alternative that we see a lot are the convertible notes. And in this case, I wanted to refer to the templates by Techstars and the SAFE set of documents, the simple agreement for future equity. We see them a lot, also very, very standard. And again, relying in that type of documents can give you all, at least to review them. If you're not familiar on what to negotiate, what to offer, etc., just read them to have an idea on what's market practices depending on the stage you are in a given time of your project. And with that, if you agree, I don't know, Juan Pablo, if you have anything else to add, or if we shall take it.
Well, I mean, I think an issue that comes up a lot, it relates to whether a convertible note or a safe. And I just wanted to take 2 minutes there. So one thing to keep in mind is to understand a safe, you have to understand where it came from. And I like safes for entrepreneurs. I don't like safes so much as an investor, but you have to really understand the evolution of a safe. So Techstars, back in about 2010, came out with a standard convertible note that really everyone in the industry began to use, not because it's the best convertible note. It has no reps and warranties. It's very founder friendly. So it has virtually no reps and warranties and almost no investor protections. So it's a very West Coast style, entrepreneur friendly convertible note, but it was put out by Techstars. At the time, Techstars and Y Combinator were sort of at the same level as, you know, sort of the leading accelerators in the United States and probably in the world. 10 years later, about 2020, 2019, 2018, 8 years later, the reality is that Y Combinator has become much more relevant than Techstars. Techstars still amazing. I love Brad Feld. He's done amazing work. He's actually my neighbor in Aspen. But the reality is, you know, you have to give credit where credit is due. Y Combinator really, you know, surged ahead. And I think Y Combinator just did not like their entrepreneurs using the Techstars convertible note. And so they came out with their own instrument, which for me was like a solution in search of a problem. I mean, and what was interesting, because everyone in tech assumes that anything that new is better, one day to the next, 75% of debt deals were being done on safes, and only about 25% were being done on convertible notes. And I remember I wrote an article, and I thought it was bizarre that I'd get on a conference call with an investor, and he or she would be like, okay, blah, blah, blah. And I talked to the entrepreneur, and they mentioned a convertible note, and I told them it had to be a safe. And I just was like, you know, I don't have a lot of hair, but I would like pull my hair out thinking, does this investor realize that a safe is worse for him or her than a regular convertible note? But they're pushing the safe. So, I mean, if you're the entrepreneur, sure. Anyway, a safe is worse for an investor than a convertible note. Neither instrument gives the investor a lot of protection, but what both instruments do is they allow the investor to get their money into the company without fighting too much about valuation. So the advantage of a safe or a convertible note is that you don't have to fight about valuation too much. You have to agree on a cap. And the rest of the term, I mean, it's standard 20% discount if it's a convertible note, 2 years to get to a qualified financing. But again, I just mentioned safe and convertible note because there's often a lot of confusion. In Latin America, less than 20% of debt deals today are getting done on safes. That's the reality. You still see safes. They're a great instrument. Oddly, Y Combinator changed their form. So now the safe's being done post-money, which is actually better for the investor. So it's like almost Jekyll and Hyde now with the safe, that the safe is like super entrepreneur friendly instrument. But then I think Y Combinator realized they might have gone too far being founder friendly. So now they've made the safe post money, which is very favorable to the investor. But I think at some point, you know, somebody at Sequoia or SoftBank or somebody who's very influential is just going to say, hey, we have a new instrument, and the safe is probably going to go away, because I think the reality is Y Combinator has sort of muddled that. Anyway, we've published an article on safe, post-money safes, I really encourage any of you that are working with an entrepreneur who's pushing a safe, he or she needs to understand the post-money versus the pre-money and how that affects them going forward. Because basically a post-money safe, le castiga, it punishes an entrepreneur for raising more money. And so it creates these very odd incentives in terms of how the entrepreneur will raise money going forward. And if the entrepreneur doesn't understand that, he or she can really end up making a mistake in terms of raising capital going forward and overly diluting themselves by taking in too much money in the next round. I mean, normally as an investor, I mean, notwithstanding what I said before, if I put in money in a seed round at $1 million valuation, and now the entrepreneur, she's hit it out of the park and she's raising $20 million at a $50 million valuation, I should be thrilled. But with a post-money safe, there's so much dilution that will occur that it really actually doesn't make sense. So anyway, I put a pin in that. So I think we have 15 minutes. Would be super happy, Victoria and I, to answer any questions that you all have. As I mentioned in the chat, I have a podcast. If any of you would like to be on the podcast, you're more than invited. Just reach out to me. I shared my email. We publish articles that deal with many of these topics. And both Victoria and I are a resource to you all and your entrepreneurs that you're supporting. So happy to answer any questions you have.
Yeah, I don't know if you want to put them on the chat or just raise your hand. In the meantime, somebody was saying, I don't know if it will be enough now or we leave it for training too. What to look for with more detail in term sheets. Maybe you can do the bullet points and then elaborate more in the next session.
Okay, if you want very briefly, I have opened the Series C term sheet. I can read you
this is such a good point, Victoria. Here's the thing in tech, you don't have to reinvent the wheel. The Series C term sheet is a great term sheet because the big problem when you get away from these standard documents is, one, you're going to spend double on lawyers. Two, you're going to end up with deal fatigue, negotiating with the entrepreneur. But third, and the biggest risk, is somebody gets creative and now the company is no longer financeable. Victoria and I spend at least 20% of our time trying to fix weird terms that somebody stuck in a term sheet at the very last minute. And so, for instance, giving somebody anti-dilution. I mean, just recently, a client of ours out of a convertible note thought they were being clever and pulled out the mandatory conversion provision, which she, and it was a female entrepreneur, didn't realize by doing that. Now she was giving the investor basically anti-dilution protection forever. So you have to be very careful. Vic, why don't you walk through the Series Seed?
Yeah, I'll pick that as an example, and if you want in the next session, we can do a deep dive on that. But usually it's very simple to manage. You put the aggregate proceeds that you're raising, the purchase price per share, the terms for the liquidation preference, conversion preference, voting rights, very, very standard. You don't need to think about it. What documentation are you going to use, which basically has a link to the Series C, which will be the definitive document for the transaction, participation rights, the board of directors, if the investor is going to get a seat in there, who will pay the cap on the legal fees that you're going to invest, future rights, what a key holder, the key holder terms for the vesting, and something very standard that you say that this term sheet is valid for 30 days and you need to close the deal. So here Juan Pablo is showing that you have the term sheet there, and then what will be the definitive agreement. Again, we encourage you all to take a look at this when you're entering into a negotiation, either as an investor or as an entrepreneur. And it's only 2 pages, only 2 pages.
Yeah, maybe, I don't know, I'm just throwing ideas, but maybe in the next training, of course, taking the confidentiality out, you can show us a very bad term sheet that left the investor unprotected, maybe, or things that we really need to know when we are doing that. Somebody
one
asked,
thing,
yeah,
that's a very good point. The one thing I want to point out is every time you do a company does a round of financing, basically the previous shareholders agreement, the previous certificate of incorporation ends up in the garbage. So for instance, with the Series C documents, they're very standard. And somebody asked, oh, and it's almost like the Series C docs is when you're raising 750, $1 million, $2 million. But then when the company does its next round, and that's, you know, a quarter inch of paper, it's 30, 40 pages. Then maybe the next round, when they're doing a real A round and they're raising $5, $8, $10 million, then we use the NVCA forms. That's 2 inches of paper. But all the Series C docs basically just end up in the garbage. Why is that important? Because the convertible note and the safe are set up to allow a price equity round to happen. The Series C documents are set up to allow the next round of financing to happen. A lot of times when people get creative, they're working with a local lawyer who doesn't know what he or she is really doing, or they're working with a lawyer in the US who isn't specialized in venture. They act as if this is the last money the company's going to raise. And that mindset does 2 things. One, it starts having the entrepreneur and the investor looking at this as a negotiation that's zero sum. And these documents are really about letting people know, hey, these are pre-negotiated documents. And if you use these documents, you're going to be set up for success going forward.
but what about, somebody asked, what happens when we sign a safe at the moment of investment and then the entrepreneur does not raise capital? How is the way to convert that?
There is no way, and there is a very well-known case of a Latin American entrepreneur whose company is worth close to $1 billion, and he raised about $5 million through safes or convertible notes, and he's never raised any more money. Again, a safe and a convertible note are very, very founder-friendly instruments, extremely so. I, as a investor, and I've invested in over 30 early-stage companies, I try to avoid investing in convertible notes and safes. On the other hand, I was offered to invest in a convertible note by this little company called Uber at a $65 million valuation. And I took a pass because I said, oh, I don't like convertible notes. So, you know, it's sometimes agreeing to a convertible note is sort of un mal necesario. It's a necessary evil. But yeah, unfortunately, as a convertible note holder or as a safe holder, you have no rights until the company raises a qualified financing, which is normally defined as the company raises $1 million of new money as part of an equity round.
Okay. Any other questions, spontaneous now from the audience? We have time for one more at least.
JP, could I ask a follow-up to that?
Sure.
Could we include, like, let's say, you know, we're aware of this,
Right.
in terms of like, okay, well, this is a risk, right, of the safe. Could we, in a side letter, sort of put in a maturation date or a date
Well,
with?
but that's called a convertible note. And by the way, Megan, it's good to see you.
You too.
And I love Inca Ventures. So yeah, but that's why I like a convertible note, because at least a convertible note. So just for everyone's, you know, just to review, a convertible note basically says when the company raises $1 million of equity financing, it converts at a 20% discount subject to a cap. But if the company has not done an equity round within 2 years, at the end of the 2-year period, and here's, you know, there's a little room for negotiation. Either the company pays me back with 6% interest, or I'm a creditor and I can exert creditor protections against the company, or sometimes it says, and it's always the investor's choice, or the investor can actually just convert its money, normally at half the value of the cap is sort of the standard. So a convertible note deals with this issue. Unfortunately, a SAFE, there's no maturity date. So if the company never raises more money, the investor never, the investor never gets their money back, and they never get equity in the company, which I agree is unfair. That's why, from your all's perspective as investors, you should prefer convertible notes to SAFE. One thing Victoria didn't mention, which I think is worth mentioning, is the nice thing with a convertible note and a SAFE is you can use those instruments and put them into the Peruvian, the Argentine, the Brazilian, the Mexican operating company. To use a convertible note or SAFE, you do not need the entrepreneur to create a holding company. The only thing you want to add to the convertible note of the SAFE is one additional line that just says that the company and the investors agree that the company can re-domicile or create a holding company in Delaware or Cayman, and that the note or the SAFE will be also converted to that eventual holding company. So that's why a SAFE, and to give you guys an idea, if you work with Victoria to do a SAFE or convertible note, I mean, you might not even spend $1,000, right? It's very cheap, easy to do, and you don't even need to create a holding company. Once you're doing a priced equity round, even if you're using Series C documents, which are almost fill in the blank, you're going to spend $5,000 to do the round, but now you have to create the holding company in the US or Cayman. That's going to be another $2,000, $3,000, $5,000. And then you're going to have to do the permuta de acciones, moving the Argentine, Brazilian, Chilean, Mexican shareholders to the holding company. And that's going to be another couple grand. So, let's say on the low end, 10, 12 grand doing a priced equity round, you could do a convertible note or a SAFE for $1,000. So, that's something to keep in mind. But that's a great question, Megan, because I've actually seen these side letters, which are so crazy. And I'm just like, hey, that's a convertible note. Let's just save ourselves the trouble. So I believe me, I've seen those in Spanish and Portuguese and, everything. So, yeah.
Well, Juan Pablo, I have to say, I'm going to disclose this in the WeInvest community that at Capria, we don't like safes. So I'm going to tell my partners, oh, you would love Juan Pablo because they say the same. It's very entrepreneur friendly, but then we may get totally screwed. So
that's a technical term. That's
yeah,
a technical term. Exactly.
Not French, just technical term. So I think this has been just almost the appetizer for the training too. As you can see, Juan Pablo and Victoria, we have very pointed questions. We are going to keep gathering more questions and get back to you for the second training. I think this issue of SAFE, thank you. We all need clarity on this because we run into this issue of SAFEs and convertible notes all the time. So we'll have other great topics for December. But one more time, thank you to all who participated. We want to hear from you, but also thank you to Juan Pablo and Victoria for your time and always being there for us.
Yes. Thank you for having us.
Yes,
oh, it's a pleasure. We love your mission, and yeah, Victoria and I are very happy to support. Yeah, for December, I'd say we'd like to keep this real and very specific and actionable. So please think about your questions. I just real quick, the topics we planned on talking about was the 2 mistakes